Construction loans are fantastically easy. My name's David. In the past 7 years, I've done approximately $30 million in ground up development. That was a combination of building subdivisions, building single family homes, apartments, and quite a few townhouse complexes. In the past 18 months, I've helped my brother inside of his fix and flip business take revenues from right around 9 million in gross sales in 2023 to 14 million in sales in 2024, setting up systems and processes. But I've noticed problems in the two verticals, and I wanted to talk today about construction loans versus hard money loans. Today, I wanted to give a brief overview of what a construction loan looks like. And it's not as complicated as people think, but you're going to have your land and you're going to have a construction loan. And hopefully, the combination of these two is significantly less than the total appraised value of the property that you're building. So, for the sake of this example, let's say you are building 2,000 square feet on a $50,000 lot, and your appraised value is $500,000. Now, when you're vetting out this deal, you are going to look at comps in the market. Ideally, you're buying a lot in a very stable community, and there's plenty of sales, preferably new construction, right in the surrounding neighborhoods. So once you've done your due diligence and you realize, like, okay, I have viable comps here that say 2,000 square feet on this $50,000 lot is going to be worth $500,000, then you're going to take those drawings. You're going to have a list of all your selections, what type of finishes are going into the home, and you're going to hire an appraiser. And that appraiser is going to give you a full report saying that your floor plan on your lot is worth $500,000. So then you're going to go to the bank and you're going to show the bank your appraisal. You're going to show the bank your drawings. You're going to give them a business plan, because every spec home is its own business plan. So you're going to give them a business plan. You're going to give them your credentials, your experience, and show them, here's my appraisal, here's my lot, here's our plan to execute on this. And then they're going to give you the money for the lot, which is called an acquisition loan. And then they're going to give you a separate but together facility. They're technically two different loans, but they will give them to you together, which is called a construction loan. Depends on the bank. And again, the best thing to do is to vet out local banks before you go and waste a bunch of everybody's time. 4, 5, 6, 10 phone calls. You can call banks and see who is even willing to do construction loans, and preferably if they will do a construction loan and an acquisition. And it's very easy, because if they do construction loans, the banks are going to want to work with you, right? Because you have real estate experience, you have a proven track record, you're a savvy investor. You're actually more preferable to the bank than a one-off homeowner. They want to work with investors. They want to work with people who are in the industry, because guess what? They're in the business of loaning money. And so if they have a customer who does 10 deals over the course of their lifetime, as opposed to a customer who does one deal, they'd much rather invest that energy into the relationship with the real estate investor as opposed to hairy homeowner. It's so easy. Like, I talk to guys in the industry, and they're so intimidated by the idea of going to conventional bankers and trying to figure this stuff out. But the reality is those guys want to work with you, and they make it pretty simple. As long as you have the tools and you present them with the items that show the financial viability of your project, they want to give you the money. And so what I've been doing is trying to work with guys in our network and show them how they can transition their skill set inside of fix and flip and naturally move it over to new construction where it's way more profitable. And believe it or not, it is significantly more simple to execute on. Anyways, back to our hypothetical here. So the bank is going to require the bank is going to require 20% of the lot. So we're saying our lot's worth 50,000. So you're going to give them the $10,000. Now up to this point you have had some expenses. You had to spend, let's call it $10,000 approximately on the blueprints. But you spent the $10,000 in the blueprints. You spent another 2 to 4,000 on that appraisal. And now the bank is considering the future value. It's the same thing as ARV in the fix and flip world. It's the ARV, the future value. So your appraiser said your asset, when completed, is worth $500,000, and they take that into consideration, and they will give you 80% of the total amount. In this particular example, the bank's going to be willing to loan you up to $400,000. Now, 50,000 of that, or I'm sorry, 40,000 of that is going towards your land. But let's say you even pull that, let's say you pull that 10,000 back. So 50,000 of that is going to go towards your land. The bank will loan, if it's the right lender. Some are going to be at 70%, some at 75%. But again, you already made these calls, you already vetted out who you want to work with. So for the sake of our conversation, they are going to give you $80,000 towards that build. 50 goes to your land. You've got $350,000 to build this home. This is a 2,000 square foot home. You should be somewhere around 140 to 150,000. You should be somewhere between 140 to 160 bucks per square foot. So the math on that is $300,000 on 2,000 square feet. So now you've budgeted $300,000 for your construction, $50,000 for your land, and you have a management fee that you put in there. You have a cost overrun that you put in there, but you build all of that in your draw schedule because you only budgeted in $350,000, and the bank is still willing to give you another $50,000. So you account for your cost overruns, you account for any calculations that you did incorrectly, and then you pay yourself. You pay yourself to manage the project. And so on this particular example, and it's not even a particularly good one because I don't know where you can buy a 200,000 square foot new construction home for $500,000. But for this particular example, your profit at the end of this would be $100,000. Your profit at the end of this is $100,000, and you didn't even draw the money that the bank was willing to give you. What I can do is I can shoot more videos where I show specific deals where we did this and show real numbers, real profitability, and actually give you blow by blow. This is more of a conversational video, but in the future, I'll do something more technical where I'm at my computer and I show you these numbers. The point of this video is to emphasize how easy it is to get a construction loan, structure it correctly, and then once you have that banking relationship, they are going to want to do over and over and over, just give you that money. And instead of making those $40,000, $60,000, $80,000 profits, depending on what market you're in, you're making a minimum of $100,000 and all the way up to $250,000 on a home that doesn't even retail for more than say $1.2 million. Hope this was helpful. See you guys on the next one.